Welcome and thanks for joining us here on Market Call. I'm Morella Fernandez. Christine Poole on the show with us today. She's co-chief investment officer at Davis Ray, and she'll take your questions on North American large caps. Here's how to reach us. Call us toll free, 1-855-326-6266. You can also email questions, marketcall@bnnbloomberg.ca. Christine, thanks for coming in today.
No problem, Morella.
We have a small GDP contraction for April. How are you interpreting these numbers?
Well, it's not surprising given the tariffs, and I think we saw a lot of pre-buying before the tariffs took place. And I think that you're right, it was a negative GDP number for April. And I think the expectations that in the months to come, May and June, it will also be negative, and we're probably going to have a negative GDP year over growth for the quarter as a whole.
So softer sort of recession?
Well, softer. I wouldn't necessarily call it a recession because usually the definition is 2 consecutive quarters of negative GDP growth. We know that the Bank of Canada, they've been on hold now for the last 2 meetings. And arguably, if it was not for the tariffs or the potential impact tariffs will have on inflation, they may have continued to cut. But they're on hold now because they want to they want to see what the impact tariffs will have. Notwithstanding the negative number we got, the stock markets have been actually quite healthy. Even the TSX all-time highs. I think in the U.S. they're hitting all-time highs now. So that tells me that the consensus, like the expectations, the market's thinking that trade deals will be announced and they'll be manageable. Corporations will either, adjust to their supply chains or maybe absorb some of it. And maybe potentially it will actually not be as inflationary as some may expect. And if that's the case, especially in Canada, because we are seeing slowing economic growth and rising unemployment, then that gives the Bank of Canada, the central banks, more leeway to continue cutting interest rates.
July 9th is the next trade deadline. Correct. We don't know whether Canada is going to have something in place before that, after that, or by that deadline. What are you thinking about the deadline? Will it be significant? I mean, clearly investors absorbed the April shocks and moved on. Do you think it'll be a shock to the markets?
I think July 9th is kind of a moot date because I think that even the Trump administration has kind of conveyed that, if they're talking to the various trading partners and they can't get a deal necessarily signed by that date, there's going to be likely extensions. And we saw, I think, Prime Minister Carney announced about a week or 2 ago, they hope to have something in place within 90 days with the U.S. So that we potentially may bring us beyond July 9th. But I have a feeling that we'll see extensions.
Steel and cars, do you think aluminum, do you think those tariffs are going to stay in place?
I hope they get dealt with because in the end, the U.S. is our trading partner. And it's, it's nice that we're going to try and develop other trading partners in the future, but that's going to take time. So hopefully the new trade deal will address those issues.
Got it. Okay, we are going to take a quick break. Christine Poole with us from Davis Ray, taking your questions today on North American large caps. Here's how to reach us. We're back in a moment. Welcome back. Let's go right to an email for Christine. This comes from Randy. He says, what is your outlook for JP Morgan as a long-term hold and a good entry point? Thank you for that. Let's take a look at the chart. Is it a good entry point? It's not one of those stocks that really goes down.
It's done very well, like you mentioned, Morella. And actually, all the U.S. financials have done pretty good, which is actually a good reflection on the potential of the economy because the banks are kind of reflects what's going on in the economy. JP Morgan, it's our core U.S. bank stock that we hold in our client portfolios. And I think it's a great long-term hold. If you hold it, keep holding it. But in terms of putting new money in here, I would probably wait for a bit of pullback. On down days, you can kind of start to average in or average down in, hopefully. But it definitely is a great organization, very well run, lots of excess capital, continuing to have plans to grow their presence in the United States. So we like the name, but for a good entry point, I'd probably wait for a day when the markets are down a bit and before putting new money to work.
Got it. Okay, let's go to the phone lines. We have Al on the line. He's calling from Nanaimo, BC. Hi, Al.
Good morning. Thanks for taking my call. I was just like to get your opinion on TELUS. What do you figure? Buy, sell, or hold?
Okay, TELUS, telecommunications companies have had a lot of challenges.
Yes.
But TELUS has been trying out some different things. What do you think of TELUS?
Well, in general, we don't actually have exposure in the telecom sector right now. It's been very competitive, and then with the decrease in immigration, that's going to take away a source of potential growth as well. So I think all the telecom stocks are providing a pretty attractive yield. But for myself, we consider, I guess, TELUS would be an income stock. And while the yield's there, perhaps they can increase their dividend a little bit every year. But just the fundamentals, I think, of the sector are not that attractive to us right now.
Okay, if you were already holding it and we've seen that drop off, would you just continue to hold it, or would you sell it off at this point?
I think I would still sell it and look for more attractive income stock that has I guess, a better outlook in their respective industry, and then also prospects for dividend growth.
Got it. All right, let's go back to the phone lines. And we have John on the line from London, Ontario. Hi, John.
Thank you, Marilla. Hello, Christine. I'd like your opinion on fintech giant Visa. I bought it at the IPO. Earnings are still growing very well, so is revenue. There's lots of opportunity abroad. I like the response to the stablecoin threat from Walmart. And, they've actually invested in the technology, which is a good way to make your enemy your friend. What about Visa for another 3 to 5 year hold? Thanks very much.
Okay, thank you for the question.
Yeah, sure. Yeah, so Visa is a name we hold. So obviously John bought that way back when they went public. So he's done very well with the stock. And we think, it's the largest payment processor company in the world. And, the transformation for digital to digital versus paper, like paper money or checks, there's still a lot of room there in terms of other countries outside of North America where, there's still room to grow that. And we saw during COVID as well, tap to pay and just people using their credit cards to buy kind of daily items became, more mainstream. Before people would reserve a credit card for big ticket items. So we think there's still a lot of growth potential. Meanwhile, they've also themselves and MasterCard are developing kind of value-added services, which is now almost a quarter of their revenue base. So, and these are services like cybersecurity, for the issuers and that's becoming more important with cybersecurity fraud. The caller mentioned stable coins, and Visa and MasterCard, they both have been doing a lot of work in that area. So I think that's very early on the development about big retailers issuing their own stable coins to avoid using credit cards. Like in the end, there's their network is very robust and secure, and consumers are going to have a lot of confidence, I think, to pivot from something like that. And as well, like I said, Visa has also been working in that area with various companies. So I don't don't discount them out of whatever happens in that area. I think they're going to be actively involved.
And there's a benefit to having the one card that you can use anywhere,
exactly, because obviously you have to use it probably within the Walmart universe or whatever company that's doing that, right?
Yeah, okay.
Yeah.
All right, John, I hope that helped you out. We're going to move on to Elliot calling from Hamilton with this question in Ontario. Hi, Elliot.
Good afternoon. Spotify's been doing quite well with increasing subs, broadening its product offerings, and increasing ad revenue. Do you think this is still in the early innings? What's your opinion of SPOT? Thank you.
Thank you for the question.
Yeah, stock's done very well. We don't own it. I guess the valuation is what's kept us out of this stock. And I mean, they were very early on with with music and podcasts, et cetera. But I think it's going to get more competitive as well. Like there's other platforms offering that.
Sure.
So for ourselves, I guess look at the chart. It's done really well, and if the valuation, like I said, it's just not one that we'd be looking to enter because of the valuation.
Got it. Okay. Let's move on then to Chris, who is calling today from Victoria with a question. Hi, Chris.
Oh, good morning, Marilla, and good morning, Christine. Thank you so much for taking my call.
Yes.
I'm hoping to sneak in a little cheeky second question, which is simply what percentage-wise is a full position for any of the Davis Ray portfolios that you manage, Christine?
Okay.
And then, of course, my primary question is on Thermo Fisher Scientific, if you still like it, if you still see it as attractive at these prices, and if you'd be buying it today. Thank you so much.
Okay, thank you for the question.
Yeah, so I'll address Chris's second question. Well, question about a full position. In our client portfolios, in our segregated portfolios, a position would either be anywhere from 2 to 4% of the overall portfolio. Okay. In terms of Thermo Fisher, we still own it. It's been a challenging year or two for Thermo Fisher. They supply all the tools and equipment to the healthcare industry. And they did very well during COVID because they were getting a lot of business in terms of the vaccine production. And so that had to normalize post-COVID. And then we had the environment of rising interest rates, which kind of detracted funding for a lot of the biotech industries. China is a market that's been very soft. And we thought, so the company has not been growing at its the historical trend that it has been. But we think that's going to start to normalize as well. Right now, for this year, we thought this year would be kind of like an inflection point for the company. But now you have, with the political change in office in the United States, there's a focus on healthcare costs, healthcare funding. And so that may impact Thermo Fisher's clients because they do a lot of work with biotech companies, pharmaceuticals. And so that's been an overhang on the sector. But in the end, they're one of the leaders in this space. We think healthcare long-term is a very attractive industry to be in because of the demographics. And in this case, Thermo Fisher supplies to all healthcare companies, all parts of the healthcare industry, and as well as universities and scientific organizations. So we think it's actually trading at a pretty attractive multiple now. And so we continue to hold it for long-term appreciation.
Are they operating just in the U.S. or are they international?
They're global. They're international.
Okay, got it. Yeah. Okay, we are going to take a quick break. We're going to be back with more questions for Christine Poole from Davis Ray in just a moment. Welcome back to Market Call. Let's go to Rocco. He's on the line. He's calling from Montreal today. Hi, Rocco.
Good afternoon. My question's on the telecom. I know they asked about TELUS before, but I'm on Bell Canada. Is it dead in its tracks? Is it dead money for now? Should I take my losses and go for something else? Or should I buy more or just hold until it turns around? So I'd like your opinion on Bell Canada. Thank you so much.
Thank you for the question. And we do want to remind people under the Bell Media brand, owner of this channel, BCE, which has been sort of at the $29, $30 level for quite some time. What's your forward look on BCE?
So we know BCE, they cut their dividend by over half. And so it's yielding just under 6%. We're, like I said before, when we talked about TELUS, we don't have any exposure in the telecom sector because we just think it is quite competitive right now. And for BCE, so yes, the dividend was cut, so that will help preserve, I guess, their cash flow and eventually help their balance sheet. They still have, I think there's still a question about their fiber strategy in the U.S. because they want to expand that. And the U.S. is a very competitive market as well. And, how long is that going to take? And when is it going to start contributing to their earnings? And then going forward, now that we have the dividend cut, I don't think there's much expectations that they're going to be in a position to raise their dividend anytime soon in the near term. And that is one of the factors we look at when we just decide on income stocks, Marilla. Not only do we want an relatively attractive yield, we'd like to have companies that have the visibility to increase their dividend consistently, medium, near term, and long term. And I don't think BC qualifies.
Got it. So if he's had it and perhaps taken a loss on it, what do you suggest for him? Hold or sell?
I would sell it and move on to something else.
Put your money somewhere else.
Yes.
Okay. Let's go back to the phones. George is on the line in London, Ontario. Hi, George.
Hi, how are you today?
Good, thank you.
Good. I'm interested in finding out more about property owned by Loblaws called Choice Properties. And I've been a holder of it for some years, and every month they seem to add 12 shares to my holdings. And I'm wondering whether I should continue holding it or sell it and get involved in something else. I know Loblaws is solid, but I don't know what to do about this, whether I should continue to hold it and get the dividend each month or sell it and get into something else.
Okay. Thank you for the question.
Yeah, so I guess it's not directly about Loblaw.
Correct.
But so Choice Properties is the real estate arm of Loblaw's parent, which is George Weston. And so Choice Properties, I mean, it is a very solid conservative income name because the tenant is primarily Loblaw.
Okay.
So,
they're not going anywhere.
They're not going anywhere, and, very consistent business, very stable. And Loblaw is actually kind of expanding as well, their discount stores. And so that will be probably beneficial for Choice because they're going to be the natural beneficiary of that. So I think if George wants to kind of have a steady Eddie income real estate company, Choice fits that. And in terms of him getting new shares every month, he must be in a DRIP program, a dividend reinvestment program, where they're giving him units versus cash, because usually you get the cash put into your account. So if George wants to, have that income stream, I think it's pretty safe. We do actually own Loblaw in our client portfolios because we do like their positioning in food retail as well as on the pharmaceutical side. And we think that what Shoppers Drug Mart, they're both leading players in those respective spaces. And Shoppers, with the expansion of what pharmacists can do in their stores, that's helping traffic. It's going to help front end because when you come into the Shoppers, you're going to pick up some stuff in the front. And for Loblaw, as I mentioned before, with the softness in the economy, their discount banners have really been benefiting. And so we see that continuing. And as I said before, they're planning to expand a bit on their discount banners. And as well as that acquisition they did a couple of years ago, TNT, which is an Asian chain. They really have been pretty quiet about it until more recently. And we're starting to see some more store openings as well. And they're actually opening one in the States, I think.
Did they absorb the TNT brand, or are they opening under the TNT brand?
They kept the TNT brand separately because it's a very well-known brand. Okay. And I think they just opened up one up on Dundas Street. And apparently it's done very well. So,
got it. Okay.
Yeah.
So they're expanding under different brands as well.
Yeah.
Okay, let's go back to the phone lines. I think we have Dominic on the line. Do we have Dominic on the line still?
Yes, hello.
Hi, Dominic. What's your question today?
No, thanks for taking my call. I'm calling about Aecon Group, ARE. Over the last 3 years, the stock price has pretty much tripled. But if we look at forward earnings, it still looks like there's a lot of value here. I'm thinking about adding to my position in Aecon. And I wonder if you have any insight on that company in a comparison with AtkinsRéalis, please.
Okay.
Thanks for the question.
Yeah, so we do like the engineering services sector, which is what Aecon and AtkinsRéalis participate. So AtkinsRéalis used to be S&C Lavland. Like they
they rebranded.
They rebranded. They had some issues with all of their construction
overseas. Yes,
and so they were over budget, and so they rebranded. And they're actually well positioned for nuclear, as I understand. So. And we don't actually own either of those two names, Morella, but we do own WSP Global in that space. So I guess for Dominic's question, I would be buying WSP just because I've known that company for a while. They do strategic acquisitions. They don't overpay. They actually just bought something in Europe. Will expand their presence there. But they're all. I mean, I think you want exposure in that space because I think it's a growing sector. And so if he owns Aecon and, he wants to keep owning it, and if he wants additional exposure, I would recommend WSP Global.
Got it. Okay, we are going to take a quick break. We're going to be back with a look at Christine's past picks in a moment. Stay tuned. Back to Market Call. We're going to take a look at past picks from Christine Poole from June 13th of last year. At the time, she picked Brookfield Renewable Partners. It was 35.19 at the time, now up, or down, 35.15. So just under a percentage in dropped return, but a total return of 6% What has been happening with this company?
Yeah, so a leader in the renewable space. We still own it, Marilla, and the total return is positive because of its distribution yield. It's been a tough year for the renewable sector.
Is this a U.S. effect?
I think partly because we know that, with the change in political office and kind of not a supporter for the renewable sector, overhang that, they're going to remove some incentives, tax credits in the renewable sector space. So that's been a headwind. And then prior to that, we had rising interest rates, which was also a headwind for this group. But we continue to hold Brookfield Renewable. We do think the renewable generation area is under a long-term secular growth theme. You're going to have these near-term, hiccups or volatility. And why Brookfield, very global, operates in more than 25 countries. It's part of the Brookfield Group, so its parent company, Brookfield Corp, owns about 48% of this company. Lots of sources of capital to grow, whether it's through their funds or their own capital. Their power purchase agreements are long-term in nature, about 90%. The average term is 14 years, so lots of visibility in terms of what they're getting for their generation power. And 70% of their revenues, they say, are indexed to inflation, so that they can pass that through over time. And then about a year ago, you may recall, they signed an agreement with Microsoft to provide renewable power generation to Microsoft starting from 2026 to 2030, so for over 5 years, primarily in the United States. And that's that amount of power that they signed under that contract represents about 20% of Brookfield's development pipeline. So that gives it visibility in terms of bringing that on board. And the company's indicated that they're seeing a lot of interest from other companies, large companies, cloud providers who need energy to power their data centers. Mm-hmm. And as well, they want to have a decarbonized footprint. So they think that there may be more similar types of contracts like this to come. And Brookfield's the ideal partner because they are so global and so large, and they have this large pipeline that they can kind of meet the commitments to some of these contracts.
Yeah, they're not setting up, they're already there. Okay, let's go to your next pick from June of last year, which was Home Depot. We'll have a look at where it was at the time, June 13th of 2024. It was $347.88 US. Now it's $365.51, so a 5% return and a total return of 8%. Do you worry about stores like Home Depot in an economy that isn't as strong as it was, let's say, last year?
Well, we've had Home Depot for a number of years, leading home improvement retailer. And last year, I guess, what happened during COVID is people spent a lot of money on their homes. So that really benefited Home Depot. They went through a tremendous growth phase. And then when everything opened up again, we saw people pivot to services and less spending on goods and their homes. And so, people were overspending and they went through a period where they underspent. And now it's starting to normalize, I think. But despite that, you're right, rising interest rates has been impacting the lower income households in the United States. They're seeing that in their traffic numbers. They're seeing that big renovation projects that require financing has been softer because people are, thinking twice about doing anything. But in the end, the homes in the United States, over 50% are over 40 years old. So there's going to be a natural need to repair and modernize. And so that's kind of a long-term secular trend. Household formation is still positive. There's still a lot of young people that are living at home. And when they move out, they're going to probably need to do some work on their new living accommodations. And they're also focusing on their pro market, which is the professional customer who does large projects and making it much easier for them to pick up supplies and eventually, and actually even provide credit to them eventually. And they've been making some acquisitions to grow their markets. They bought MRR company, maintenance, repair, and overhaul company, a company that specializes in roofing. So they're growing that, and they still think they have about a 17% market share by their calculation. So they still feel they have lots of room to grow.
Okay.
And so, we think that you focus on the long-term secular trends. And yes, near term, there might be some headwinds. But in the end, I think, money will flow their way.
Okay, we're running out of time for your third pick, but let's get to that quickly. S&P Global on the New York Stock Exchange at the time, June of last year, 437.19 U.S., up to 518.99, 19% return, total return of 20%. Are they the data service?
Yeah, they provide, their main businesses are the ratings, so themselves, Moody's and Finch are the rating agencies, so an oligopoly, and they provide market intelligence with desktop tools, analytics to the Financial Services Committee, and then as well, community, and then the indices business, which you refer to is anything that's branded S&P, whatever, the ETFs pay them a little fee off of that. So all their businesses, very profitable, operating margins, kind of at that 50% range. A lot of them are subscription-based. So that means there's a recurring revenue stream over 50%, so more visibility on future earnings. And so we think they're very well positioned, great businesses, very scalable, and so we continue to hold it.
Got it. Okay, we are going to take a quick break. We'll answer more phone calls, emails, and phone calls when we come back. Stay tuned. Welcome back. Let's go straight to the phone lines. Barry is holding in Halifax with a question. Hi, Barry.
Hi, Christine. I wonder if you could give me your thoughts on CP Kansas City. Is this a good time to open up a position, is it?
Sure.
Okay, thank you for the question. What do you think of the railway lines first generally, if you don't mind?
Yeah, I mean, I like the railway sector, and actually one of the railways is one of my top picks, but it's not CP Kansas City. They're all oligopolies as well, and their infrastructure will never be rebuilt. And likely the CP's acquisition of Kansas City Southern is probably going to be the last acquisition in that area. So we like this sector. We consider it kind of like a soft industrial. It is somewhat cyclical because some of the volumes will be impacted if the economy is weaker. But they transport so many goods and so many necessary goods, they're always going to have an underlying base of business. And because it's an oligopoly, they tend to have relatively decent pricing power. Transportation by rail is superior than, let's say, by road.
It's less expensive.
Less expensive, and so they're going to have some amount of pricing power. Now, in terms of CP Kansas City, the stock had pulled back, I think, on concerns of trade and tariffs and trade, because Mexico is a big route for them when they bought Kansas City Southern. But I think, it looks like something will be ironed out. And I do think that it's probably an attractive entry point to enter the rails. Now, this is not the stock that I've chosen just because in terms of valuation and other metrics, we think there's another railway that's more attractive.
Okay, but generally you think rails are a decent investment?
Yes, I do. Yeah.
Let's go on to Mike then. Mike's calling from Windsor, Ontario. Hi, Mike.
Hi, I was wondering about Amazon. Mm-hmm. Would it be a good level to get in for a long-term hold? Thank you.
Sure.
Okay, thank you for the question. Are you more interested in the Amazon sort of cloud business these days than retail?
Well, the cloud business, as you say, Marilla, it's always been kind of like the growth driver and in a way subsidizing the retail operations, because retail, the margins are much lower. Like they're kind of like mid-single digit to high single digit. They can, I think they hope to get a high single digit in North America. Internationally, it's still very, I think even below North American. But once again, we've been, they're automating. They're using robotics to try to decrease the cost of delivery. And they've got the Prime membership, which is a nice subscription-based business where it's recurring revenue stream. But their cloud business is definitely growing and is the, I think, the growth driver. Their investments in artificial intelligence, et cetera. So we do own Amazon in the Davis Ray Growth Equity Fund, which is much more growth-focused. In our segregated portfolios, it's not a position. But, the stock's pulled back a little bit. And I'm actually, looking at it as a potential addition to our segregated portfolios. Obviously, the company's very well run, very focused, and I do think AI and robotics automation is going to be benefiting their retail operations.
Why do you think it hasn't recovered from the April lows that some of the other tech companies have?
Well, I think it's probably maybe tariff driven, because you think of what they bring in, like they have delivery from everywhere around the world, China, and so the thought is that, maybe you're going to see some slower traffic or volumes, and so it hasn't fully recovered yet.
Got it. Okay. Let's go to another caller. Wayne's on the line in London, Ontario. Hi, Wayne. Wayne, are you there?
Yes, I'm here. Hi. My question is on Emera, EMA on the TSX. I purchased some back in about April at around 59-ish. And it just seems to be kind of going sideways. So I was thinking of getting some more, but I just wanted to know what your opinion is on it.
Okay, let's talk about Emera, which does, I guess, electric and natural gas.
Yeah, it's a regulated utility. They made a big acquisition about a year ago, which increased their presence in the United States, particularly Florida. So I think that's kind of like the growth driver for Emera. It's not a utility stock that we own. I mean, I think it's fine. It provides a nice yield. And once again, one of my other top picks is also utility stock. So I think I'd rather buy that one than Emera. But if you want an income stock, Emera is probably fine as well.
I think he's wondering, too, if he should add into what he bought at, which was 59, he said.
Yeah, so he's a little ahead. And in this past rally, the last few months, it's not really been the, safe defensive names that have moved, right? It's been more of the growth-oriented names. But it's still up by a couple dollars. So and plus the dividend, that's not bad.
Got it. Okay, let's go back to the phone lines. Dave's on the line today from Brantford, Ontario. Hi, Dave. Let's try him one more time. Dave, are you there? Okay, we may have lost Dave. He had a question about Manulife, if you have any thoughts on Manulife.
Yeah, in life insurance company, Asia is a growth area for them. The stock's done very well this past year. It's a decent income stock as well with a nice yield. My preference right now, Marilla, in the financial services sector in Canada is probably with Canadian banks. But if he holds Manulife, he could probably keep holding it and do fine with it.
You mentioned growth, or that is the growth area for Manulife. Just wondering with the tariff situation and they export so much to the U.S., the economy is a little shakier than it used to be. Is that a concern for a company like Manulife?
Well, they sell services, like they sell life insurance products over there, so that wouldn't be subject to tariffs necessarily. Now, the only thing, I guess, if their economy gets hurt by decreased trade, let's say with the United States, that might be a headwind for the company. But because it is more service-oriented, I'm not as concerned in terms of the tariffs.
Immediate effect. Okay,
yeah.
We're going to take a quick break. We'll be back with Christine Poole from Davis Ray, taking your questions on North American large caps. We're back in a moment. Stay tuned. Welcome back, and thanks for joining us on Market Call. We are going to an email from Wayne. He says, I'd like to ask about Kushtar. Where do you see it going from here? And your thoughts about the 7&I buyout. So they're trying to buy the Japanese company, 7&I, which owns 7-Elevens.
Yes.
It's a big deal, but it's not necessarily being embraced by the Japanese owners.
No, I mean, they signed a non-disclosure agreement, I think, about 2 months ago, so they can't really talk about it too much. I know the company just reported the results yesterday or the day before. And it's a big overhang on the stock because if it goes through, then they're going to have to go through anti-competition, reviews, and I think that's one of the major reasons that Japanese parent has concerns about that, and it could be a prolonged period of time, that review period. And then to fund it, because it's a very large acquisition, like you said, they're going to have to issue some equity. So that's also overhang on the stock. And then meanwhile, the company's stop buying back its stock until this gets resolved. So for all those factors, stocks pulled back. And meanwhile, their operations, particularly in the United States, they're seeing softer traffic because, lower income consumers tend to go into these convenience stores more. They're spending less. So, that's soft. And this company, what they do, convenience stores and gas stations, it's not really a high growth sector. So historically, they've grown through acquisition. But they've gotten so large now, probably in North America, there's really nothing else for them to buy because a lot of the big oil companies exited their retail operations, and Kushtar was a natural buyer. So now you see them looking, overseas. But like you say, there's a big question as to whether it's going to, the parent's going to go for it, and then whether it's going to get approved. So there's a lot of uncertainty about what's happening in terms of future prospects. Yes, the stock is trading at a discount to where it has historically, but we're not looking to add this at this point.
I had someone say to me they think that it was just too big of a deal. It's too big of a deal for Kushtar, and they understand why they're going after the 7-Elevens, but they think they're taking on too much. Do you agree?
Potentially, because like you say, it is so large. I don't think they've ever bought anything this big, and there's going to be integration risk and regulatory reviews. I mean, the review could take over a year, and then what happens? They're kind of like in limbo until they can figure out what they're going to do. And meanwhile, their stock is relatively cheap, but they're not buying back stock because they know they're going to need some financing.
Yeah. All right. Let's go back to the phone lines. Tudor is on the line from Calgary today. Hi, what's your question?
My question is on, thank you for taking my question. First of all, my question is on Berkshire Hathaway, and it's kind of a two-part thing. First of all, I was surprised that it hit new highs in March and April or May, and now it's pulled back. And I was wondering why that, in Christine's view, why is that?
Okay, let's have a look at the line chart for Berkshire Hathaway, and I know there was concern about the retiring of Warren Buffett, and people had questions about the Canadian who's going to take over. But is that all that's happening here?
Well, I mean, we knew he was eventually going to retire, but I guess maybe it was unexpected when he announced it, and the individual that he's named that to succeed him is very well known, so it's not a surprise that it's him. He's indicated he was going to be his successor. So I'm not quite sure why. It's always difficult to determine short-term movements in a stock. Potentially, we know that Apple is a big position in the Berkshire portfolio. I think it's close to maybe half the portfolio. They have trimmed it back over time, but it's still a very big position. And we know, Apple, so maybe I'm just kind of theorizing that, because Apple with the tariffs, potentially, they're going to face headwinds if there's tariffs coming out of China, or the Trump administration is saying, you can't just, we want it in the United States production, you can't switch it to India. But that's not realistic. I think they would rather just pay the tariffs than that you can't bring all the manufacture of the phone into the United States. Too costly. So that could be one of the reasons it's pulled back a bit. And like I said, Berkshire is kind of viewed as a kind of well-run defensive company, with ownerships in lots of companies across different sectors. So it's almost a snapshot of the U.S. economy. And like I said, like the rally since April has really been focused on more of the more super growth kind of areas of the market. And maybe, we just had some fund flows going away from Berkshire. But it's a solid long-term hold, for an investor.
Got it. Okay. Let's go to Juanito calling from Scarborough, Ontario. Hi, Juanito.
Yes. May I have your opinion on Enbridge, please?
Yeah, sure. Thank you for the question. So Enbridge owning the pipeline, I guess, reliable.
Yes.
Not really going to do much. Does it fluctuate with the price of oil at all?
It does a bit because there's exposure there because it's in the energy patch, but obviously not as much as a producer. So, I think Enbridge is a really attractive income name, and we've been buying it here. It's an income name that we own in our portfolios. It's giving you a yield of close to 6%, very large infrastructure in natural gas and crude oil. And, dividend, they increase it a little bit every year. And obviously, if, we follow through with this infrastructure investment energy plan that the federal government is proposing, it would be positive for pipelines because you need to transport, energy and crude, et cetera. But I think, Enbridge has said, like, they've been hurt before trying to do pipeline projects, and it gets kiboshed because of all these interest groups, that they really want to see the support of Indigenous groups as well as federal government support. But, if that actually comes to fruition, I think the energy infrastructure names in Canada will be beneficiaries.
Okay, so would you invest at where it is now, sort of betting on that growth that's going to come?
No, I would be buying it just based on what their existing operations, and that's kind of just a potential plus, because that's still going to be a few years out, before that happens.
Got it. Okay, let's go to an email then. We have Frida who's written in. She says, "What is your outlook for Shopify?" Shopify is one of those stocks that sort of seems to go up and seems to go down quite a bit. Why does it move the way it moves? It's always like in the top movement position in the red or in the green.
I don't know. I mean, the valuation is very high. So I think, if there's like a potential growth scare or thoughts that things will slow, then the stock moves quite a bit, and people probably trade it a lot. It's not a name that we own. I mean, it's a great company. It provides a platform for small and medium-sized businesses to sell their goods online. So it's kind of democratizing e-commerce for anybody. You don't have to be a company. You just pay for their services, and they give you the platform. But it trades at a very high multiple. And so that kind of has kept us out of the name. And you're right, the share prices tends to be quite volatile. You saw the drop off post-COVID when they really overexpanded. And potentially maybe now with trade, et cetera, that maybe it impacts volumes to a certain extent until we get more clarity. But yeah, I mean, it's a excellent company that provides a great platform for e-commerce, but valuation has kept us out of the stock.
Got it. Okay, that is all the time we have for phone calls and emails. But Christine will share her new top picks. That's coming up after a break. All right, time now for Christine's top picks. Her first one today is CN Rail. We did talk about the railways a little bit before this. And you like CN Rail out of the picks that there are. Why do you like CN?
Yeah, so for CN, as I said before, Mirella, price, volume, and velocity or the effectiveness of their operations are key drivers for the rails. And so we talked about price. They usually get pricing. And CN has a very good track record for safety and how train speed, et cetera. So volumes, like last year for CN, generally speaking, the economy was weaker, so that hit all the rails. But for CN, they also had to absorb some labor disruptions for the rail operations as well as at certain ports. So that really was a headwind for volume, so that came off quite a bit. So they have easy comparisons this year. Company affirmed their guidance after they reported the first quarter. They're expecting 10 to 15% earnings per share growth. Now that's assuming that there's still some volume growth, so it's not like we're going into recession. So a softer economy. And so I think because of the challenges they faced last year, the valuation now is at a very attractive level versus a historical price to earnings multiple, as well as the group. And as well, we don't consider CN an income stock, but it does give you yield of about 2.5%. The company actually went public in 1995. It was a Crown corporation prior to that, and it's increased its dividend every year since that as well.
Okay, so CN Rail moving forward.
Yeah.
Let's get to your next pick, which is Fortis on the TSX, which is a gas utility company.
Yes.
Tell me why you like Fortis.
Yeah, so Fortis, we talked briefly about utilities and we asked about Emera. And so Fortis has been a long-term holding for an income stock, regulated natural gas and electric utility. Over half their revenues come from the United States. They made some acquisitions there, so very diversified, very defensible, visible cash flow stream because it is regulated. They've increased their dividend for the past 51 consecutive years. It gives you an attractive yield of just under 4%. Okay. And I think they're also, as an added plus, because everyone talks about AI and data centers, they are in regions, jurisdictions, where some of these data centers are being built, Arizona and Michigan. So they will be beneficiaries of increased transmission needs, because as these renewable power plants get built to service these data centers, you need to transmit and distribute the energy. So that would be Fortis's play into that. So we just think, and over the long run, the stock's done very well, kept up actually with the general market, if you look at it from, let's say, 5-10 year basis. And with the recent pullback to about $64, I think it's a very attractive entry point.
How long have you guys held it, roughly?
Oh, I'm going to say over 10 years.
Okay, you've had it for a
long time. Yeah.
Okay, let's get to your next pick, which is ZELM on the New York Stock Exchange. Mm-hmm. So this is a water technology company. Yeah. What do they do? So
they treat, transport, and test water, drinking water as well as wastewater. Okay, this company was spun off from ITT back in 2011, but it's been around for a number of years. And we think water is a very scarce resource. Like the reason why we own it is because we looked at the water sector. 70% of the earth is water, but only about 2% is drinkable. So scarce resource, aging infrastructure in developed countries, UK, United States, so they have to refurbish. They provide equipment and services to utilities. Emerging countries, as they urbanize, increase obviously consumption of water. Lots of industries require water, whether it's semiconductor manufacturing, industrial various industrial activities. And if we see some of this reshoring back to the United States, potentially increased demand for water for some of those processes. So there's very attractive long-term, I think, secular trends in place. ZELM is probably one of the few pure play water companies that are publicly traded out there. So it does trade at a premium because of the scarcity value of a pure play water company.
They're across the U.S.?
U.S. and around the world. I'd say about 50% of their earnings come from the United States. The rest outside of America, outside of North America.
And you made a good point. They're one of the few publicly traded companies that do this. Why is that?
I'm not sure, actually.
Just wondering, like, how they got.
I mean, they were spun out from a larger conglomerate, and then they've actually made some acquisitions over time to increase their presence in different verticals. And they're actually going through an operating margin improvement program, 80/20, where they're focusing, because they've got a lot of products, so they're kind of focusing on the companies, or the customers and the products where they make most of their money from, and kind of streamlining their product portfolio. So we expect some margin improvement from the company over the next couple of years as well.
And again, how long do you think you've owned it?
I'm going to say about 5 years or so,
over
5 years. Yeah.
Got it. Okay. We are going to leave it there on Market Call. We appreciate you joining us, and thank you, Christine, for coming in. We'll see you soon. We're going to leave you right now with a look at the markets. We'll see you again on Monday.